Hello there, my name is Stallone-Obaraemi Samuel, and I'm very glad to be here today to share some thoughts with you with regard to what is happening in the space and the business space, especially if you're a business person. And for those of us who are probably investing in the stock space, a couple of days ago, the stock kind of showed some signs of life, some growth, some upward movement, and we had lots of selling pressure here and there, and that's kind of finally abating. So it's time to kind of enjoy it and also prepare. You see, the challenge many of us have had is not preparing for the rainy days. I mean, that includes me too. But it's important to prepare while we hope that what we see now is going to last, and then there's going to be some kind of steady climb. Let's also prepare for what if that climb does not happen. Okay, what steps can we take in order to prepare ourselves for the market when the market kind of resumes its downward march? Because practically speaking, it pays to hedge against market declines. Many people do not understand when we talk about market declines what we mean, but it's important for us to get prepared for the market when the market goes down. It's extremely important. I'm going to share this evening or afternoon or morning, wherever you're watching this from, a few steps that you can use in order to protect yourself. There are a few simple strategies that can help you to cross the line from a state of panic to slightly being inconvenienced, and making the best of it. It's very crucial that we learn to fight back against market downturns with a few strategies I'm going to share with you right now. And why is this an important subject? Because we found out that most investors make very little effort to hedge against market risk. In fact, some even rarely think about hedging, except when it becomes brutal, it becomes really bloody, and that's when they begin to think about how to protect their funds, especially when it gets very tough and very hard. Most of the times, investors simply accept maybe the stock or crypto market's occasional downturn as a price of admission for making money during its upturns. It's time for them, for many people, to think it's time for them to get in, and then when the market goes up, they make profit. But really, when the market goes down, it's a good time to get in because the market actually rises over time. And for a long-term investor, it can usually be okay to ignore the downturns if they invest in good stocks, or maybe in the case of cryptocurrencies, in good cryptos, good projects. And when it begins to go back up, if they remain patient, it could be really a plus for them. But there could be very painful moments like we have right now, okay, when the market goes down and the losses deepen and the recovery time for portfolios actually increase. The recovery time actually increases so much so that sometimes when you compare the dollar cost and the time cost, you find that the time cost is so huge that the dollar cost almost doesn't count that much. That is why it pays, practically speaking, to hedge against market declines. Okay, it really pays. The best thing about hedging is that it doesn't have to be complicated. So I'm going to talk about like 1, 2, maybe 3 strategies, a few strategies that can help you to cross the line without necessarily cutting yourself. So strategy number 1 will be to generate positive returns in the market. Strategy number 1 will be to generate positive returns in the market. Very critical that you learn to generate positive results in the market. How can you do that? You see, a hedged fund could bring balance during the stock market's rough patches. This has to do with buying stocks that are believed that you believe that could be rising, while selling stocks that you believe could be falling. And by simultaneously betting on both sides, stocks can, by betting on both sides, both falling and rising stocks, or in this case, maybe falling and rising cryptos, okay, one could actually eliminate or at least reduce the market risk that afflicts traditional investment strategies. So traditionally, you kind of go one way, But when you hedge, you go both ways and you are prepared for wherever the market goes, whatever the market brings. It's a better way. And the reason I'm talking about this today is that many of us just get into the market and we just ride with the market. We just take all the swings. I mean, go up and down. But we're saying, what if you begin to think about, ask yourself this question: what if I win, whether the market goes left or right, whether the market goes up or down? What if I win? In other words, this strategy could generate positive returns even during times when the overall stock market is falling. If you take a look at this, kind of sounds pretty good, right? Essentially, this strategy was born of the understanding that things could go wrong sometimes, even if they go right most of the times. Okay, one eminent writer, financial writer, James Grant, explains this when he said, the gem of the case for a hedged portfolio is that long-range predictions about economic growth or interest rates or corporate cash flows are likely to be no more reliable than the 7-day forecast on your weather app. So he's saying at the end of the day, you've got to be prepared. He went further to say that adherents of the hedged approach have nothing against bull markets, or as far as that goes, bear market. They aim to be indifferent to each while producing satisfactory results in both, quote and unquote. See, the satisfactory results in which Grant refers are what most professional investors call absolute return. It is a return that is not dependent upon or relative to market direction. It does not require nourishment from a bull market trend. There are a wide variety of hedge fund strategies that have emerged as a result of the strength of this hedge fund system. Almost, you see, although many of them still focus on buying and shorting stocks, or maybe in some cases cryptos, depending on what they deal on. Others utilize some combination of bonds, currencies, features, private equity investments, derivative, and a lot of other things. Here's the thing: no matter the exact tactics, most hedge funds attempt to construct some type of market neutral portfolio. When we talk about market neutral portfolio, it's in a portfolio that no matter where the market goes, the owner of the portfolio makes profit so that they can generate positive returns. That's why they take that hedged fund, position, the hedged position kind of. No matter if the market goes, whether it rises or it falls. In theory, the market neutral strategies are the fat-free ice cream of investing, if you understand what that means. I mean, it's like fat-free ice cream. You get, it doesn't matter where the market goes. It is direction-free. No matter where the market goes, you're going to make some profit, okay, relative to what happens in the market. And it's important that you put this into your investment strategy. Many people do not understand it. They just wait for the market to go up or go down, and they wait and wait it out. We all fell victim for that. Some of us are still falling victim for that because we're learning. Okay, the investment space is not a space that you say you learn, you know everything at once. You see, when times now, the other strategy I would share with you is a strategy that we call playing defense and offense at the same time, both ways, making sure that you get what is needed in order to stay strong through the market. You see, when times really get tough, you can also select short sales or other portfolio hedges like inverse ETFs that can help your portfolio stay afloat and score when most typical investment strategies are striking out completely. You see, short sales produce profits from falling stock prices. Now, because of that, they can provide a valuable hedge to your conventional portfolio. Yeah, and to be sure, short sales can also be risky, even when they are part of a market neutral trade. I already explained that earlier, but the same way that can be risky, that's also how owning stocks during the bear market can also be risky. So furthermore, we've come to also learn that some investors have very little interest in advancing in advanced strategies like maybe options or short sales. And that's fine. Most people don't even like betting against companies or even thinking or living with the idea that they will lose money if a stock increases in value. So if you're one of those, you might prefer the more basic forms of hedging. You can look at traditional investments like gold stocks or oil stocks, which can sometimes, twist and when the market turns, or maybe zig when the market zags. You can also consider index funds that move in the opposite direction of the index to which they are tied. You can also look at a fund that profits from falling bond prices. So there's a whole lot that you might want to take a look at and make sure that you take advantage of the market and don't get caught. Many times we fail because we don't put all of these things into consideration. My name is Stallone-Obaraemi Samuel. My sincere desire for you is that you go on succeeding by becoming a better version of yourself. Bye for now.